Congress has 6 weeks to decide if crypto platforms can pay yield on stablecoins. Senate Banking Committee Chairman Tim Scott said on March 17th that he expects to have a stablecoin yield compromise proposal in his hands by the end of this week. The announcement signals the first concrete movement on the stalled crypto market structure bill since Coinbase withdrew its support in January. The catch: Congress has roughly 6 weeks of working days before the 2026 midterm election cycle freezes all major legislation. The yield question banks do not want answered. The fight is straightforward. Crypto platforms like Coinbase want to pay interest on stablecoin balances, the same way a savings account pays interest on cash deposits. The banking industry wants that banned, because a Coinbase USDC yield account paying 4.5% APY competes directly with savings accounts paying a fraction of that. The draft language being negotiated would reportedly ban yield payments for simply holding stablecoins in an idle wallet, but allow activity-linked incentives, rewards tied to transacting, staking, providing liquidity, or posting collateral. The distinction matters. Passive yield killed, active yield preserved. For anyone using a stablecoin-funded crypto card, the implications are direct. If the bill passes with a strict idle yield ban, platforms may restructure how they compensate users for holding USDC or USDT balances. Spending through a card could become one of the qualifying activities that keeps yield flowing. Coinbase walked once. It might walk again. Coinbase pulled its support from the market structure bill in January 2026 when earlier drafts threatened to restrict stablecoin yield programs entirely. The company's USDC rewards program is a core revenue driver, and a ban would hit its business model hard. Scott credited 3 names for getting negotiations back on track: Democratic Senator Angela Alsobrooks, Republican Senator Tom Tillis, and White House official Patrick Witt. That bipartisan lineup suggests the compromise is not one party steamrolling the other, which makes passage more plausible. But Decrypt reported that a White House announcement could come as soon as tomorrow, and that industry stakeholders have already drawn a red line. If DeFi protections are removed from the bill, they walk. 4 unresolved fights behind the headline. The stablecoin yield compromise is the most publicly visible issue, but at least 4 other disputes are still unresolved. Trump family crypto ventures. Democrats want an explicit ban on the president and his family operating crypto businesses while in office. Republicans have resisted. Scott said negotiators are very close to landing the plane on ethics language, but close is not done. DeFi carve-outs. Senator Mark Warner has been pushing for decentralized finance restrictions. Industry groups have said they will abandon the entire bill if DeFi protections disappear. This is the nuclear tripwire. KYC and AML standards, know your customer, and anti-money laundering rules remain under active negotiation. The scope of these provisions determines whether no KYC crypto services face new federal requirements beyond what individual states already enforce. Regulatory quorum. Both the SEC and CFTC currently lack full bipartisan commissioner slates. Without confirmed commissioners, any regulatory framework the bill creates may sit unenforced. The SEC just classified 17 crypto assets as digital commodities with the CFTC under a new joint taxonomy, but implementing deeper market structure rules requires full agency staffing. 6 weeks is not a lot of time, Representative. Dusty Johnson put it bluntly, "We are very close to being out of time." Congress historically stops moving major legislation roughly 2 months before midterm elections. With the 2026 midterms approaching, the window for a floor vote is closing fast. If the bill dies this session, everything resets. New Congress, new committee chairs, new drafts. The 2-year cycle that began with the SEC safe harbor proposal and the CFTC commodity classifications would lose its legislative capstone. The market is not reacting dramatically. BTC sits at $73,054, so 15% over 24 hours as of March 18, 2026. ETH at 2,312, and the Fear and Greed Index reads 43, neutral. Traders appear focused on today's Fed decision rather than a bill that has not yet been formally introduced. But if the draft language drops this week and Coinbase signals it can live with the terms, that calculus changes quickly.